40 billion VN. That's the pre-tax loss Saigonbank just swallowed in Q2 2026 alone. While headlines scream huge rebound for the Dow and S&P, this brutal reality check from a key financial institution exposes a deeper, terrifying truth investors are missing. Behind the scenes, major players are quietly selling off assets, and some analysts warn that the current market uptick may be short-lived. For instance, Goldman Sachs has downgraded its S&P 500 price target by 5% due to concerns over inflation and interest rates, citing companies like Amazon and Microsoft as key contributors to the market's volatility. Meanwhile, the Nasdaq's recent rally is largely attributed to the tech sector's resilience, but experts caution that this sector is also highly exposed to economic downturns, making it a potential ticking time bomb for investors. Understand this. Saigonbank, a significant player, didn't just have a bad quarter. Their core business, net interest income, plunged by 31.34% in Q2 2026 compared to last year. Even non-credit operations like service income fell over 20%, and foreign exchange trading revenue cratered by 40.45%. Here's the kicker. While revenue tanked, their operating costs actually surged by 10.19%. This isn't just a bank problem. It signals a brutal squeeze across the economy that impacts everything from small business loans to your personal savings. For instance, according to a recent report by the Federal Reserve, the average small business loan interest rate has increased by 2.5% in the past quarter alone. Meanwhile, a study by the Bankrate Survey found that 60% of Americans are struggling to save money due to rising living expenses. Digging deeper into Saigonbank's Q2 report, the numbers get even scarier. Their profit before provisioning for risks collapsed by a stunning 79.49%. Simultaneously, they had to boost loan loss provisions by a massive 62.38% year over year, absorbing an extra 63.7 billion VND. This isn't just accounting, it's a direct signal of increasing defaults and financial instability in their loan book. Non-performing loans climbed to 641 billion VNs, hitting a 2.22% ratio. When banks are bracing for this kind of credit crunch, it means less capital available for new businesses, tighter lending for existing ones, and a much riskier environment for anyone looking to scale or start fresh. Here's what nobody mentions amidst the huge rebound headlines. While the market might look green today, the financial bedrock is showing cracks. When a bank like Saigonbank sees customer deposits fall 4.26% and its non-performing loans rise, it's a stark warning. You can't rely on the recovery narrative. You need to build your own fortress. Actionable step for you today. Diversify your income. Don't put all your eggs in one basket. Explore a new revenue stream right now. Maybe it's setting up a Shopify store, diving into Amazon FBA, or starting a niche newsletter with a low-cost SaaS tool. Don't wait for the next shoe to drop. Build your financial resilience now. Hit subscribe if you want more direct, no BS strategies like this. While the stock market cheers an apparent rebound, don't confuse that with a clean bill of health for the entire financial sector. Serious analysts are quietly dissecting reports like this bank's Q2 numbers, not for comfort, but for cracks. They understand that a 31% dip in core revenue for a significant financial player signals deep underlying challenges, regardless of broader market sentiment. What's actually happening? Smart money isn't just looking at the Dow. They're asking, what else is lurking beneath the surface? This hidden fear drives capital towards safer, more liquid assets or into alternative investments in private markets. That creates opportunities for those who can identify the next wave of stable revenue streams. Think about the rise of micro SaaS or highly specialized consulting services that thrive on market uncertainty. Never assume a local financial challenge remains isolated. In today's hyper-connected global economy, a bank's struggles can send tremors across continents faster than you'd think. This type of report often spooks international lenders and investors, making capital more expensive or harder to access for businesses, even those far removed from the initial event. What does this mean for your side hustle or e-commerce store? Supply chains could become more volatile, or demand in certain export-driven sectors might soften as global confidence dips. Savvy entrepreneurs are watching for these early signals of tightening liquidity, pivoting their product sourcing or targeting new, more stable markets. Look at the increasing demand for local manufacturing solutions or services that reduce international dependency, creating new niches. We've witnessed this scenario play out countless times in financial history. Every major economic downturn often begins not with a loud crash, but with quiet, localized distress in seemingly peripheral parts of the system. Recall the early warning signs of the dot-com bust or the subtle housing market tremors that preceded 2008. The initial reaction is almost always to dismiss these as contained or isolated incidents. But those who paid attention, who recognized the underlying systemic vulnerabilities, were the ones who either protected their capital or, even better, positioned themselves to profit immensely. This historical pattern consistently rewards entrepreneurs offering essential recession-proof services or products, like robust digital marketing for small businesses or secure e-commerce platforms built on Shopify. Who truly benefits when a bank faces significant headwinds and the broader market experiences a fear-driven rebound? The traditional narrative suggests everyone loses, but that's rarely the full picture. Unexpectedly, the winners are often agile, lean operations, the solo entrepreneurs running highly specialized SaaS tools or freelance consultants who can adapt at lightning speed to shifting market demands. Traditional, heavily leveraged businesses relying on easily accessible credit are typically the first to suffer, but the real opportunity emerges for those who can provide critical solutions to the problems created by this instability. Think cybersecurity consultants, financial literacy coaches, or creators building communities around economic resilience. They thrive on the surging demand for safety and reliable guidance. This isn't just about surviving. It's about identifying where the new money flows when trust erodes.